Good afternoon, Chris. It's October, can you believe it? And September didn't disappoint in terms of volatility and it being known for being not a great month. How did you see it pan out?
Well, September was at least a nice month for the weather, but for the stock markets, it was mixed. And actually, not just the stock markets, it was also the bond markets too. Generally, investments were not good, were not happy. And it's funny, isn't it? Because the Bank of England, for once, decided not to raise interest rates. And the same with the Federal Reserve in the United States too. And so people are probably thinking, hang on, central banks are starting to stop raising interest rates. Why are financial markets suddenly a bit uncertain? And of course, it's because the reality of quite a lot of debt in the world, still slowish growth, but still positive. But I think a realization that we're not going to move back to zero or very low interest rates, maybe for a very, very long time, certainly not in any foreseeable future. And that's kind of said to people, well, hang on, we are going to face reasonable interest rates for the next 5 or 10 years going forward. And that therefore means the valuation that you give to equities and bonds and other investments has to change a little bit. And you put all of that together, and I'm not particularly surprised that we've had a little bit of market volatility, but I would observe that this kind of debate has been going on for all of this year, and frankly, some of last year too. This is a very traditional, normal debate in financial markets. And it's funny, you and I, Rob, have been around for a few years now. We can remember other markets when things weren't particularly excitable or difficult, even when interest rates were at these sorts of levels. The same with inflation too. But the reality is financial markets globally are still workable. There's still opportunities there. It's just not as perfect as it may have seemed to many investors 5 or 6 years ago before COVID and related. So we're just having what I would call a pretty normal market backdrop. Not impossible, still lots to be doing. I would still say the biggest risk out there is not being involved. If you sort of panic and say, oh my goodness, I've got to take all my money out, got to put it all under the bed, that is still the worst thing for pretty much all investors to be doing, irrespective of their particular personal requirements and timescales and related. So call me glass half full all the time. Maybe I always am, but I still feel okay about the world. And when I look to Q4, which traditionally is actually quite, as you say, September is traditionally not a particularly great month for markets. By contrast, when you look at Q4, particularly October and November and the run up to Christmas, that's actually generally quite workable, quite good for markets. So I'm looking forward to that. Got a big earnings season coming up. And I would say if the Bank of England's got any good sense, they'll continue not deciding to raise interest rates or keep them unchanged. And I think the same in the States too. And I think that's a good backdrop, a workable backdrop for investors around the world.
Great. On that point then, Chris, about bonds, because we've seen them in the last few days actually really come off with the changes in yields. We know that bonds are negatively correlated to interest rates, and we've seen that there was that unexpected pause, because if you remember when we last spoke at the start of September, the Bank of England meeting hadn't taken place yet, and we were expecting maybe the pause, maybe there's going to be another increase. So it did come as a slight surprise. On that point then of interest rates and bonds, when do you think that this cycle might be breaking to sort of ease off the pressure on the bonds? Is it going to be summertime next year when we maybe see central rates start to ease off a little?
You're absolutely right, Rob, that sort of the biggest adjustment occurs when interest rates start to come down. And I think your timing's probably right. Next year's obviously a difficult one for the UK market. We've got an election in all likelihood and related. Who only knows what's going to happen with that? But the thing about bond markets and interest rates and related is that they kind of work also to different drivers too. We've already seen in the last few weeks things such as mortgage bond yields and rates already starting to come down. And that's because you have that supply and demand influence, as you see with almost everything in the world. And as we're seeing in the mortgage rate market, obviously less demand for mortgages, and therefore banks and building societies are having to offer better deals to get some business in. And the same will be true in the bond markets as well, in the sense that even though you've got uncertainty, maybe still some inflation, or the need for governments to kind of finance their deficits, the reality is that bond markets always, like equity markets, look forward. And as an investor, you've always got to try to say, what's going to be happening next? And next tends to be in 12 or 18 months' time. So let's say, Rob, you're absolutely correct. The rational time for bond markets to start to be behaving themselves more overtly is, let's say, in 9 months' time or so. That would tell me that the financial markets today are already going to have to be starting to work that in. My guess is the adjustment is that clearly that policy is not coming as quickly as some people hoped. There's probably a few people who hoped that January, February next year will see some interest rate decreases, and that's not going to happen. It certainly, as you say, is going to be much more of a mid to sort of autumn next year sort of thing, be it here or in the States or in Europe. But my feeling is that policy shift that we've seen in recent weeks has kind of gone a little bit too far now. My guess is that bond markets will start to perform in the fourth quarter of this year. Not materially. I would still say that if you look from a total return perspective, that's your general return plus any interest rates and other yields that you get from an investment. My guess would still be that equities will probably beat bonds in 2023. And you're seeing that already when you look at the average equity market performing against the average bond market. I still think that that's going to be the case. But bonds, as you say, still play a role in diversifying the portfolio. And even though portfolio management is never perfect and never easy, diversification is super important. In fact, I'd say after the importance of participation, I would say diversification is the second best important thing to be following, because unless you're not only involved but also diversified, that's when you can see some uncertain volatility in your portfolio. And as I know, Rob, you look carefully at what an individual investor is thinking about, what their requirements are and related. And that's the key always for successful investment. Participation and diversification. When you put those two in, then you've got a good chance that over the medium term, we should all be medium term thinkers in any case, thinking about the next 5, 10, even more years, depending on your age. That's how you should be looking at investment markets. And on that basis, I think life is still workable. The world is still growing. And it's still lots of excitement out there. It's just not as perfect as it was in the 2010s. But the 2020s is not going to be impossible. We caught through COVID. We've moved through that. We're now moving through sort of anticipation of not only we've moved through the higher inflation, but the need for higher interest rates. We're now getting the other side of that. And now we've got the reality of what's growth, how is the world shifting and changing, where are the opportunities out there? And the global world is still workable, as I would say. So there's still opportunities out there for investors.
Brilliant. Thanks, Chris. Last thing to wrap us up on then, because you touched on it again, the general election next year. The Chancellor's already said there's going to be no rabbits out of the hat, but we're on an election year. Can you see anything maybe in the spring budget?
Well, we've got actually, of course, two. We've got a statement coming up later this autumn, and then, as you say, we've got the budget, and then we've got the election. Oh, we've got all of that happening also in the States and India and various other countries around the world too. So lots of politics out there, even before we touch on geopolitics and other unfortunate events also occurring in the world too. The reality in the UK, I would say, is that you'll always get some rabbit out of the hats before an election. You always do. It's just inevitable. So would I anticipate that there's going to be a few opportunities, special opportunities for certain areas that will be unveiled at some point in 2024? Absolutely. Whether people take any account of them in their not only their political decisions, but their day-to-day economic decisions and trading decisions, that's a different question. All I do know is that, as we learned actually approximately a year ago now, that governments, if they're going to be successful, a bit like ourselves as individuals, we've got to have smart financing choices. And smart financing choices is not just only having money in the bank. You've also sometimes got to be investing in the future too. So my feeling is a smart government will not only be talking about the options for tax cuts or other shorter term little rabbits, sort of indicated to people, but also that medium term scope of how matters can still be attractive and interesting. And of course, lots of discussion at the moment about what's going to happen with some of the new railway opportunities or not, as the case may be in the UK. That's a very, I would say, indicative discussion about how any smart investor, just like any ultimately smart politician, is talking the longer term as well as the shorter term. So my guess is 2024 is going to be interesting at many levels, but don't perceive that it's going to be lots of easy, immediate kind of positive or negative aspects to it. I would say personally that there's so many elections in the world next year that frankly, any smart investor is broadly ignoring the politics and trying to focus a bit more on whether companies are making money or not, whether trading is still and trade opportunities are still growing or not. And on that basis, I remain optimistic on that front. I still think the world is seeing a good amount of trade out there. We're fortunately seeing fewer inflationary issues. We have to keep our fingers crossed about matters such as energy prices and related, but we moved through that last year, and hopefully we'll do the same over the winter period and into 2024. And if we do that, it's a workable backdrop out there. It always is.
Brilliant. Thanks very much, Chris. Next time we're going to be chatting is going to be November, so we've got Halloween between now and then, so hopefully there's not too many ghosts scaring the stock market between now and then.
Hopefully not, but if there is, as always, the key is how you react to them. Never worry about volatility. The key is to react positively.
Brilliant. Thanks, Chris.
No problem.